kind of in a crazy state right now, so we're going to do our best to maintain some composure as we go through this. So what do you have to think about when you're going to approach the topic of how to buy a business, or what do you need to do to even start to think about that process? First of all, you got to realize that this may take a while. There's a lot of things that go into due diligence and research in trying to determine what it is that you want to buy and whether or not it's a good fit. So, be prepared to spend a lot of time on this endeavor. Where are you going to search to find the right company to acquire, or companies, and what similarities or synergies exist to your current objectives? Managing relationships. Sometimes there are going to be more entities involved in a deal or a transaction besides just the buyer and seller. There are other third parties depending upon the deal elements. So let's say that you've got a deal that involves real estate. You may have other people that really are not going to benefit either from the buyer position or the seller position, but you need their approval to move forward with the transaction. It could be granting of an easement, for example, or it could be working with a title company or appraisers and things like that. All those are third parties that have to be listed out, organized, and kind of managed as you go through here. There are a lot of volumes and volumes of data and documents that you're going to collect, review, analyze, and want to keep record of. Valuation and pricing, those are certain things that you've got to consider too. And then once you go from there, you're going to be getting into actually writing the offer, negotiating it with the seller, and then moving from that step to legal, financial, and other regulatory requirements, if they are, again, depending on the industry that you're looking in. Some may have licensing requirements, hazardous material requirements, things like that you may or may not have to consider. And then lastly, the transition plan. The earlier you think about the transition plan, the better off you're going to be, because you want to make sure that your team is on point to transition various elements of the business. And we'll cover some of those things here today. Well, it's important to learn from other people's mistakes. So let's take a look at a few good deals gone bad. These are public acquisitions that really went south. They did not go so well. And you can look up each of these if you're not familiar with them. First of all, Quaker Oats. They bought Snapple for $1.7 billion and sold it for $300 million. Big loss there. Sprint Nextel was another one where really the cultures did not align. In 2005, that was about a $35 billion merger when you look at the valuation of each of those two companies. And in essence, 2013, Nextel was no more. The brand was really non-existent. Sprint did keep some of the Spectrum assets on their balance sheet, but in terms of really the Nextel brand, I mean, when's the last time you saw somebody with a push-to-talk phone? Bad culture integration on that one that led to the erosion of that value. America Online, Time Warner, that was another one that lost almost $100 billion in value in 2002. So even the biggest companies that have the most sophisticated M&A teams and deal attorneys and accountants and financial analysts, sometimes these deals do not go as well as they could otherwise. So let's take a look at some things we can do to try to avoid some of these missteps. One of the things you've got to really understand is who you are. Okay, so what are your objectives? So before you go looking on the outside, you've got to look on the inside, and that goes the same for a company too. If you're looking to acquire a company and add it to your existing company, and there's various roles there just in that one category, you've got to understand what it is that you're looking for, okay? It's important to know, if you're a company, where your strengths and weaknesses are and how acquiring a company will help augment where you are in your positioning today amongst your competitors. And maybe that's why you want to buy a company. Maybe you want to go acquire a competitor so that you can add value to your own entity. If you're an individual, you've really got to look at your experience. Okay, what's gotten you to where you are in your career today? Whether that's your education, your current job, other jobs that you've had, certifications, those sort of things. Really got to understand, okay, what all do you bring to the table and where you are right now? And then what's your risk tolerance? and how do you want to move forward in this endeavor. You could look for a company that maybe your most important thing is where it is or how big it is or a specific industry. You want to make sure that you stay inside your comfort zone, or if you're willing to go outside of your comfort zone and take on a little more risk, how are you going to fill that gap? Are you going to have somebody run this company that's going to report to you, and are they going to be the expert in that field? And you've got to really think through how you're going to handle those things that come up. The asset type is also important, and this goes back to really who are you, right? And what do you want to do? Are you looking for an operating business, or are you looking for purely real estate type of investment, or are you looking for more passive income? Okay, we work with some clients that really they solely want to buy operating businesses. They want to be more of a hands-on owner-operator. Other clients of ours really just want to kind of sit on the sideline and help finance deals, right? They don't want to be the guy or the gal that goes in every morning and unlocks the door, but they want to participate from an investor standpoint, and they want to help the business grow by providing some sort of financing instruments, let's say, debt or whatnot. So there's different roles for different investors depending on what your objective is. You also have to consider, well, based on the size and what you're looking for, how much do you want to invest and what form of financing makes the most sense for you? How much should be cash, and then if you're going to leverage the deal at all, how much should be bank financing versus mezz financing? Of course, not every deal has a mezz component or even needs it, but it can be an attractive solution for specific transactions, and we'll talk a little bit more about that. The last thing you need to think about is not necessarily the last thing. It's honestly something you need to think about a little bit early on in the process, and that is, why are you doing this, and what's your exit plan eventually? It's okay to not know necessarily when it will be, but at least have an idea of what do you plan to do with this company long term. Some options might be to grow it and sell it, okay? Another option might be to sell it to the person that's going to run it. Another option might be sell it to the employees that are there at the company via an ESOP, or you might want to pass it down to your next generation, your children, or someone in your own family, and use it as a part of your own estate planning. Those are some options you need to kind of think about going in, because the same reasons why you're attracted to buy this company or look at some companies to buy, someone else is going to be on the other side of that a few years down the road, and you're going to be in a different seat at the same table. So at least think through those things now. You can also do other things too, like IPO and stuff like that, if you're talking about a company that's of some size. These are some steps in your buy-side process, okay? We won't go through every one of these today, but just to give you an idea of some of the things that you really got to think through. Once you define your target objectives, and we talked a little bit about that a few minutes ago, what is it that you're looking for? Is location or geography, how important is that to you? Size of the company, industry, maybe the specific sector that you're in based on your own experience. So if you've done your internal review and now you know, okay, this is who we are, this is who I am, this is what I want to go out and try to get, then you're going to take that information and generate a list of potentials. So in this part of the process, you're really thinking about, how do I take my objectives now that I know who I am and what I want? Where do I go to find these companies, right? So you can source different lists via different databases. You can simply Google different companies. We subscribe to a bunch of different databases that have a number of things like this in them. So, you can buy things from Hoover's or Dun & Bradstreet that would be a database of every company in the whole country if you wanted to go that far. Then you can start to filter some of that stuff based on your own criteria. But in the end, you really are trying to get a list of as many companies that fit your criteria as possible. Now, of course, this list doesn't mean that they're for sale. It would just be pure coincidence if they were already on the market, so to speak. But it's a list of companies that fit what you're looking for, or at least you think they fit what you're looking for. Then you got to reach out to them, and that's going to be either via email, letter, phone call, however it is that you've got to find the owners and reach out to them. And then you start engaging in these conversations. or you hire an advisor to do this for you, right? And once you do that, you're going to start to really understand the inner workings of these businesses, their management team, and that sort of thing. Once you find a company that's willing to talk about a possible transition and their exit plan themselves, it's really important to ask them a couple of very, very key questions. A lot of people, for some reason, don't think to ask these questions, and you're going to waste a lot of time if you don't ask these two questions. The first one is, how many members exist in their structure? So how many people own the company, and what percentage does each of them own? Let's say you have a company, ABC LLC. They may have 5 different owners, and each one of them owns 20%, for example. That tells you right there you've got to negotiate with really 5 different people depending upon their objectives. That leads me to the second point. The second question you've got to ask early on is, okay, now that we know who owns the company and how much each owns, what are each of those individual, either membership unit holders or shareholders, what are all of their objectives? Yesterday I had a meeting where there were three people that owned the company. One was 80%, and the other 2 gentlemen owned 10%. So they all have different objectives. The 80% owner, his desire is to go ahead and sell and retire. One of the 10% owners has about 3 to 5 years where he wants to continue working in the business, and he would like to remain a 10% owner. The third guy, 10% owner, he has no plans to retire. He's the youngest of the 3. He would like to continue to work and help grow the company. So once you understand where everybody is today and what they want to do, then you can start to take that into account and really draft a plan that's going to meet all of those objectives. It's great to know if you've got somebody that'll stick around for a while that's already a member of the current management team. That's a value in your court that you would want to take advantage of. As you're talking to the members of the management team that own the company today, be very, very mindful of the current culture. Culture is the number one thing that will kill a merger or acquisition post-close, because we can pretty much solve financial issues and operational challenges. Those tend to be more black and white, right? If we can understand it well enough, we can usually put the resources behind it. But culture, for some reason, is a little bit touchy-feely, right? And so sometimes, without paying enough attention to it on the front side, it can really cause issues when you're trying to transition with certain individuals. If you've been used to doing things one way for 20 years, and all of a sudden things are going to be different moving forward, sometimes people have difficulty with that sort of change. And just be mindful of it right out of the gate when you're talking to the members that already work there. You could be a suit and tie guy, and if you're trying to buy a construction business that is mostly blue collar, and their jeans and boots on a daily basis, that's important to know how you're going to deal with that. So you've got some notes now. Let's say you're talking to a few different potential sellers, and you want to start to rank what you think are, what's good and what's bad about each of the conversations that you're having. You'll sign non-disclosures at some point in this process. You'll start to review their financials, and then you're going to want to put a value on what they've got. It's important that you build your team, okay? You're going to want possibly M&A advisor. You're going to want a deal attorney. You're going to want an accountant or financial advisor, really to help you sort through all this information, okay? Once you get their input, and we're going to talk in a minute here about some of the things you want to make sure you cover with them, you're going to put your information into an offer. Okay, so what is it that you're willing to extend to try to buy this company? Then you're going to negotiate that a little bit with the sellers, and then you'll want to engage your attorney if you haven't already to do the actual legal documentation. Okay, the financing is important. We'll touch on that, and then if there's real property involved, you may or may not. If there is real property involved, you want to get an appraisal, and if there's not, then you would maybe want to appraise some other assets or things like that before you close the deal, and then start to transition the business itself. All right, let's go to the next piece of information here. When you look for your company and you start to have some side conversations with your attorney and maybe your M&A consultant and your accountant, give some thought to two things for sure. What type of entity are you going to use to buy this company? Okay, the two most common we see are LLC or corporation. And then what type of acquisition makes the most sense for you, whether that's stock or asset? So let me kind of cover a little bit of both of these. Full disclaimer, I'm not an attorney or an accountant. These are just things that you need to be mindful of when you go talk to your advisors about both of these things. So usually, most of the time we see LLCs as buying entities. So I'm going to buy a company, I'm going to create, an LLC to be the buying entity, and then I'm going to use that to acquire this company that I'm going to make a run at. We have seen recently the use of C Corps again in the marketplace, depending on a couple of factors that you want to be aware of. If you plan to hold this company for 5 years or more, and you create a C corporation to be the buying entity, the IRS has a 1202 election in the code, and you can ask your accountant about it. It could be advantageous to you unless you plan to pull a lot of cash out of this entity between now and the 5 years. If you hold it in 5 years or more, then your taxes can be really minimized when you go to sell it because it was used as a provision to try to stimulate the economy. One of those types of provisions. Not a lot of accountants are familiar with it, but again, it's the 1202 election in the code under a C Corp status. So just run that by them to see if that makes more sense for you, because when you go to sell it down the road, that could save you quite a bit of money in taxes. The reason why you might not want to do it again is if you're going to pull a lot of cash out between now and then you're going to be taxed on that as you go. But there's some ways that you can look at to minimize that. So those are conversations that you definitely want to have with your deal team. That type of acquisition, whether it's a stock acquisition or asset acquisition, also can be important to you and also can be important to the seller as well. Usually, depending on the seller's basis in the company, a stock acquisition is going to mean less taxes for them. Sometimes we see this in negotiation. Maybe your price is a certain amount for an asset deal, and you could actually offer a little bit less in a stock transaction, and it would net the seller the same. Okay, so that can be used in your back pocket if you need to lower your purchase price offer, and maybe you'd be willing to do a stock transaction versus an asset transaction. You definitely want to talk to your lawyer about it, though, because depending on the industry, there may be some risk that would be more associated with a stock deal versus an asset deal. Okay, what am I talking about there? Well, if you buy the stock in a company, you're acquiring all their historical liabilities, and so that could be important if it's a risky industry. A lot of times, like if you're buying a company in the healthcare field, for example, I've seen attorneys advise their clients not to do stock acquisitions just because you don't want to accidentally inherit a liability that no one even knew existed. If you're buying a company, though, that's relatively low risk and your attorney says, yeah, that's probably okay, then it could be worth it to you to just buy the stock in it because maybe you could get a bit better deal for it. It also can be easier. I'll just say this real quick on that one point. If you have government, contracts and you have certain licenses and things like that with government entities and things, if you're going to buy the stock in the company, usually you just roll right through because the current entity is the one that has those contracts and those licenses and that sort of thing. If you do an asset transaction, more times than not, you're going to have to assign those contracts and licenses to your new entity. And not anything you can't get over because it happens all the time, but it's just another point in your transition plan that's going to take some time to do it and to do it correctly. All right, let's talk about our financing plan for just a second. There are three main forms of consideration when you're buying a company. The first is obviously cash, right? I could go to a seller and say, look, I'm going to pay you, $10 million for your company. I'm going to write you a check at closing, and that's it. There are the other two forms of financing that are out there. Primary forms are seller financing and then what's called earnouts. So seller financing is just seller, carrying back some of that note, and they're going to be stepping in as a bank would, so to speak, or if there's a bank that you're using, they would be more times than not in second position, behind that bank or subordinate to the primary debt. So this little chart here, your equity is really, it's the last thing on your balance sheet because it has the highest risk involved, but also it's where the highest return is, potentially in any deal that you structure. Your mezz debt, if you need it, can be in your capital stack that's going to cost you more in interest, but return a higher rate to the mezz lender. Right now, we're seeing mezz deals anywhere from 10 to 13%. Some may go to 15, but right now we're seeing kind of 10 to 13% as a good private mezz rate for interest-only loan. So you might be able to do senior loan to a certain amount. Maybe you need some mezz financing to close the gap there in a deal that you're going to do. And if you put all this together, you have your financing plan. So those are the top two. Now the third one, and an earnout, let me explain what an earnout is. We're actually seeing more of these than we used to. People would talk about them a lot, but not really implement them. But over the last year or so, I've seen more deals with earnout components. And what an earnout is, basically, it says to the seller, okay, I'm gonna pay you X amount if and only if certain objectives are actually achieved by the company moving forward, so post-close. Any cash that's given and any seller financing at closing, that's looked at historically. It says, okay, look, you've built this business and we're going to pay you based on those numbers, a guaranteed amount, at closing or moving forward based on what's already happened. Earnout says, I might pay you X if the business does Y. Okay, and for example, let's say you've got $3 million total purchase price. We're going to do $1 million cash at closing, $1 million in a seller financing note, and $1 million in earnout. And that $1 million could be broken into, let's say, 4 $250,000 payments over the next 4 years. So one over each of the following years for 4 years. If our revenue in the company is, let's say, more than $3 million on an annual basis. So if we have $3 million in the calendar year that is our gross revenue, then we would be obligated to pay the seller $250,000 a year for 4 years under that scenario. It helps shift the risk a little bit from what could have been historical to what's now going to be future performance of the company, and you allow the seller to participate in that when you're negotiating to try to get a lower purchase price up front that you're going to have to guarantee when you close a transaction. If you're going to implement an earnout, just bear in mind that the closer you are to gross revenue, the easier it is to audit, and the less likely you are to have to argue it down the road. For example, let's say if I've got an earnout based on EBITDA or net income or something like that, then I'm subjecting all of my expenses to argument. It's just a lot easier to say, okay, if gross revenue is a certain amount, then that's how we're going to do our earnout, because the seller's going to want proof of, yeah, that's what it is. And so you can very easily send them your tax return, or the copy of it that has your income on it, the gross revenue, your financial statement. Those match, then you should be good to go, and that'll take a lot less of your time down the road. Working capital. When you're thinking about how you're going to buy the business, don't forget to think about, well, what do I need for working capital moving forward? Am I going to have inventory to acquire? Am I going to need to buy certain things? Do I need a working capital line of credit to take care of payroll while we're transitioning, that sort of thing? So you want to make sure you think about that. If you're buying the stock in the company versus the assets, then you're inheriting AP and AR more times than not. So you want to make sure you're looking at all of the working capital components there right out of the gate. Okay, now you get to a point in the process of the deal itself where you're going to have to go through due diligence. There's two main reasons to do due diligence, and for whatever reason, I don't know, usually only one of them is considered, and it can really cost you down the road. So let's look at both reasons why you want to do them. The first one is why everybody does due diligence. It's to make sure that you fully understand what it is that you're acquiring. Okay, these are the main categories listed here on this slide. So you're going to want to get all of this information from the seller. The second reason to do due diligence is the one that most people don't really think about a lot, and it's really to build and organize a file system for you and your company moving forward. What do I mean by that? Well, sure enough, 3 months after you close a transaction, you bought this company, someone's going to ask you for, hey, what was the EIN of the company we acquired? Or, hey, do you have a copy of their tax return from last year? Our accountant needs it for, to compare fixed assets or whatever. I mean, there's a bunch of different reasons why you're going to want this information moving forward. So if you build it correctly during your own due diligence, you'll also save yourself a ton of time and having it all right there where you need it to move forward with whatever questions come up, okay? For example, if you're doing an asset transaction, you're going to have a list of all of the assets the company owns, and the selling entity will have already told their county where they're located that, hey, these are my assets that I'm going to pay corporate personal property tax on. Well, once you buy the company, even if there's no real property involved, you're going to get a bill of sale, and you're going to take that to the county where it's located and tell them, okay, look, I just bought these assets via this company acquisition, and they're going to retitle those into the new entity name. Okay, so that's just one example of something that has to be thought of during the transition plan. But the first part of it is just getting this information in due diligence so you know what's already there and what's already listed. Some of these would be really quick points to go through. If there's no real property involved, then the only real thing you need for real estate would probably be the current lease, if there is one, and any information around that. If there is real property involved, then you've got a whole other list of things that you want to make sure you cover: surveys, possible environmental assessments, and that sort of stuff would be in play depending on what it is. When you start to finish your due diligence, okay, and you've got the deals coming together, and trust me, there'll be a night or two or maybe more where you think that there's no way this is ever going to get closed because of emotions or whatever the case may be. Hang in there, because it'll happen. Okay, it'll happen. You just got to make sure you're patient with the process itself, and you can work through any challenges that may arise. Your transition plan, break it into three main components. Okay, administration is one, sales is the second one, and operations is the third one. So you got to do this before you close the transaction. So probably somewhere in the middle of due diligence, you want to start thinking about how we're going to close this deal and how we're going to transition it, and what systems are in place today that we want to keep and which ones are ones that we want to replace. For example, insurance is, I don't know why, but sometimes it's the last thing people think about. So don't get caught in a situation where you're trying to scramble to get the right insurance in place. As a part of your due diligence, you're going to review all of the current policies, okay? That's general liability, workers' comp, property insurance, employee health insurance, anything that has anything to do with the current insurance that the company has. And I would recommend you reach out to the current insurance provider. Usually there's one person that's the agent or broker that's involved with the current policies, and just let them know, hey, look, we're in the middle of due diligence. We're more than likely going to acquire this company. What do we need to do to make sure we don't have any gaps in coverage? Okay, so we're doing a deal right now where that's currently the situation, and the buyer is reviewing all of that information right now. Taxes, licensing, permits, all that stuff is something that you want to make sure that you've covered. Another heads up, okay, let's say you buy a company and in the contract you've got it where the seller says, yep, I've paid all my taxes. And in the contract it might even say, well, if that turns out not to be true, then you're not liable as a buyer. IRS doesn't really see it that way. The IRS will come after whatever they can. So just because you've got that provision in your contract, this is one of those weird things where IRS is going to trump whatever's written in a contract potentially between two parties. So how do you double check that? Well, you got to get with your attorney and make sure that they validate for you that all taxes have been paid by the selling entity. All right, so that's not just income taxes, but sales tax and whatever other tax it may be owed. Just double check all that. Make sure that you don't get a surprise visit from the IRS on the road sometime. HR is important. So there's a lot to know here in HR, but I'll tell you a couple of high points when you think about buying a company. If you're buying the stock in a company, then usually your human resources, payroll, and benefits, can pretty much just roll on. But if you're buying the assets, what you're doing is you're changing the employer, right? You're changing the name that's going to go on the paycheck today compared to what it'll be tomorrow. So you have to make sure that you have a plan for that. There probably will be a pay period where employees get 2 checks. Let's say I owe an employee $1,000 and we close in the middle of that pay period. The selling entity would pay, $500, and the buying entity would pay the other half. So there's a transition to think through logistically on timing on how you want to do that. 401k is another thing you want to make sure you look at. If you have a 401k today and there's common ownership in the future with the company that you're going to buy, then the rule says that you're going to have to offer that same 401k plan to your new employees. So you got to get with your 401k administrator and have them amend the plan so that you can do that. We just did one of those recently. And so that's something to be mindful of. If you are buying a company that, let's say you don't have a 401k plan, but they do, then you may have to do the reverse and offer it to your current employees. Or if you both have a 401k plan, for example, then which one are you going to use moving forward and how you want to handle that? Stuff that you need to think about through your team. Okay, sales is an area that you want to integrate as soon as you can, and that would cover functions like sales leaders, forecasting, how you process orders, that sort of stuff. Operations, also very important. If you're looking at a manufacturing company, what systems are they using today? Whether that's software, IT, communication systems, that sort of stuff, and then your processes moving forward. How do you want to integrate all that? And again, a lot of this depends on the type of entity that you're going to buy or that you want to buy, and then you can work a plan around that. You might need, for example, you could need a mechanical engineer and an industrial engineer to lead a project if it's complex, where you're dealing with different sort of operations, or you may not need that at all, if that's not even a factor. Okay, so that's a very, very high level of some things that you might want to consider. Let me see if I can unmute you guys, and I will open it up or so. If anybody has any questions, we'll be happy to try to answer them. Don't be afraid if you've got one out there.
Hey, Christian, can you talk a little bit more about earnouts?
Well, either I put everyone to sleep or I did a really good job trying to hit some of these points.
Let's see. Christian, can you hear me now? Hello? Christian, can you hear me? Hello?
I'm muted?
Yeah.
Oh. Okay, apparently I cannot hear the questions that are being asked, so 1 second. All right, let me ask, if you guys don't mind, if you could just send me a message via the chat icon, I will take questions that way. How about that? And then I'll read them out loud. For some reason, I cannot hear the questions. All right. I don't know if okay. Here's a question coming in off the press. How much cash reserve should a potential buyer have on hand? Okay, that's a good question. It depends, obviously, on the company itself, but if you're gonna buy an entity and you need some cash to operate, usually a good rule of thumb is going to be about 60 to 90 days worth of operating capital. So whether you're going to get that from a revolver from your bank or have that cash on hand to lend to the company is just a simple metric that you might start with. And again, it doesn't have to all be cash necessarily. You might look at a working capital formula where you've got cash on hand plus good accounts receivable minus AP, would give you an idea of what to hold on there for minimum 2 months. 3 months would be probably plenty. I'll say though, one thing about that too, if you're looking at a company in the construction industry, depending on how they take deposits and do draws, sometimes you can minimize that depending on where the projects are in the cycle, the work in process cycle. For example, if you've got a construction company that takes, let's say, $100,000 draw up front, then you can use those funds to buy supplies and pay for labor for that project where you might otherwise have to go get a working capital line or have additional cash on hand. Good question. All right, here's another question. All right, let's see if I understand it. When earnouts are used, isn't it only a component of a deal which provides a means to increase the value of the company and ultimately realize more dollars for the seller? In other words, seller cannot back out of the deal once target is hit, correct? Yeah, that's correct. I mean, a seller can't back out of the deal because you've already acquired the company, right? It's a mechanism to try to negotiate before you close, but it's only implemented after you close. So you would have already acquired the company, so there's nothing for them to back out on. Really, the only argument they would have would be, hey, the company did meet that metric, therefore I'm entitled to this extra funds, and then you want to keep that easy to prove one way or the other. And something to talk to your accountant about too. If you're gonna implement an earnout, where you put that in the contract's important. If it's actually going to be part of the purchase price itself, then all parties are going to move forward with that being in the purchase price, and you tell the IRS in terms of asset allocation and the asset transaction how to allocate the purchase price. Right, both parties have to fill out a form to say that. So if you've said, okay, I'm going to, in our example earlier, it was $1 million, I think. So if you said in the purchase price is $3 million, one of which is in an earnout, the seller is going to go ahead and pay tax on that $1 million in earnout as if they were to receive it. And then if they don't get it, then they would have to file an amended return usually. It's something you want to talk to your accountant about, though, to make sure you understand how that's going to play out. Your other option is, and I've seen this, it seems to be a little bit cleaner so you don't have to worry about amended returns later. You can lower the purchase price and have a consulting agreement or something like that that really functions as the same thing. So maybe I change my purchase price to $2 million, and I say, okay, we're going to also pay you, $250,000 for 4 years if these certain things are met in the company moving forward, and that can just be in the form of a consulting agreement or whatever. So they pay taxes when they receive it, but not necessarily out of the gate based on a purchase price calculation, if that makes sense. Well, I don't see any more questions coming in, so I guess I'll hang out for another couple of minutes. But if there are none, thanks so much for joining us on our first webinar. We're going to do these. Our plan is to do them once a quarter, so be on the lookout for the next topic, and please, share that information for those that you think might benefit from it. And if we can help you do anything, our contact information is posted here. And with all the craziness in the market today, just hang in there. And if you're looking for a private transaction with a little less volatility, you know where to reach us. So thanks a lot, and everybody have a great day.